You have mentioned these companies on Money Talks and made our listeners money. And that's the takeover aspect. When you find something that's really undervalued and then, you get a big boy coming in and paying, takeover premiums like 25, 30%, and you've had, close to 24 of those.
Yeah, firstly, it protects you on the downside. When you're buying stocks at a discount to net asset value, one of my former clients used to say, he was from Newfoundland, so pardon the twang. It's hard to fall out of bed when you're sleeping on the floor, by. So when you're buying stocks at a discount and things correct, it gives you some protection.
Right.
But the upside, and we don't like to buy things and, hope there's going to be a takeover.
Yes, fair enough.
Yeah. But when you're buying quality real estate, and when the data from Preqin, I think $600 billion of dry powder sitting with the Blackstones, Brookfields, private equity funds, fully funded, sitting in cash, looking to buy properties, they figured it out, right? They figured out the cheapest way to buy real estate is often through undervalued shares of publicly traded enterprises.
I always look forward to the chance of talking with Jeff Olin, Vision Opportunities Funds, also the Vision Alternative Income Fund, et cetera, because their track record's been exceptional. Also, they've been identifying for our audience takeover targets that have really played out. But it's more than that. It's this incredible insight into what's going on in the variety of real estate markets. Jeff, I'm going to start with asking you to sort of define the different markets out there. Like, I guess you think of commercial, you think of industrial, but it's much broader than that.
Yeah, one of the differences between the publicly traded REIT universe and the private market is 92% of the private real estate market is made up of what is known as core real estate sectors: office, industrial, retail, and apartments. The non-core sector is less than 10%, whereas in the REIT sector, the non-core sector is over 50%. So, for example, data centers, towers, healthcare, self-storage are more than half. And what's important about that, Mike, is those are the sectors that are generating the highest cash flow growth. And so you get that exposure to public markets. The second thing is our strategy specifically, and the opportunity in publicly traded real estate securities, is to buy real estate through the stock market at a discount to the value of the real estate in the private property market. So that's what we do. We look at the underlying net asset value of the real estate. What is that real estate worth in the property market, and to compare it to what it is trading at on an applied market basis in the stock market. And of course, the difference between real estate and any other asset class is the size of the private market dwarfs the size of the public market, yet there is an arbitrage between the two. We'd rather not compete with Blackstone. We'd rather sell to Blackstone, which we've now done 4 times in the last 5 years. And then since we were last on your show, Government of Singapore pension plan shows up in Canada in May, and they announced a bid in conjunction with the founder to buy InterRent apartment REIT apartments in Eastern Canada at a 35% premium to where InterRent was trading at in the stock market the day before that announcement. And this would mark the 22nd takeover of a portfolio holding a Vision at an average 28% premium since our inception 17 years ago.
I also want to emphasize, though, as I say, Vision and your team, you look inside the publicly traded markets because they misprice on occasion in both directions, though. And Vision has made a lot of money. And I can tell you've made a lot of money for Money Talks listeners over the years by saying, hey, this sector's way overvalued, or this individual entity is way overvalued, and you've made a lot of money playing it to go down. So you've got so much flexibility in here, plus liquidity, by doing this a unique approach by I hate that word, investing in the real estate market, through the stock market, the publicly traded markets. The other point you're making, I'm sorry, I just want to emphasize it, is people have a tendency when we say real estate to think residential, of course, that's where they live. And not that you guys don't do a lot of residential stuff too, but there's so many other aspects that can be a very strong opportunity, while maybe our particular view of residential isn't very strong. I'm just saying, I'm glad you're reiterating that. I mean, I'm thinking of things that you guys got in early into data centers. And, now I think the public is sort of starting to grasp the opportunity there, as just one example.
Yeah, I mean, listen, our strategy is not to be bulls for real estate. We're a long,
Yeah.
short approach. We're significantly aligned with personal investments. And we seek to make money for our clients irrespective of market direction. So today, to your point, our biggest short weight is in U.S. life science office space. Why? There's three big regions for life science office: San Diego, San Francisco, and Cambridge, Massachusetts. By far the biggest is Cambridge. 30% vacancy rate in Cambridge life science office today. Another 15% of the current inventory is under construction with new supply with limited tenants. This is pretty ugly. Then you have pressures from the Trump administration in terms of healthcare funding, National Health Institute funding. And so this today, we think supply and demand, we say, is our blood, and supply and demand looks out of balance in the sector.
So that would be exactly a great example of how you approach it. And again, that's how you've had winning years every single year since inception there, because you can play both directions, but you can also identify which sectors. Let me talk about one that's, you guys, of course, are experts in, but the public's familiar with REITs, real estate investment trusts. What's the valuation there? What's the valuation compared to alternatives for me for investments?
Yeah, I mean, REITs today, on average, I don't know anybody invests on average, but on average,
Mhm.
historically, over the last 20 years, REITs traded at about a 0.6 times multiple discount to the S&P 500. So about 60 basis points lower multiple. Today, that's 6.5 times multiple discount. That
Mhm.
is massive. The two periods of the last 20 years where it was that big was the global financial crisis in March 2020, which proved to be pretty solid periods where REITs can
Yeah.
outperform. And so, again, we're not here to be bulls on average, but on average, the REIT sector looks interesting. There's been no recovery in REITs. It's been really ugly 5 years. I mean, Vision's done quite well over that 5 years, but the REIT sector has really had limited recovery.
Other things that are in the news right now that you look at is, Canada's been talking a lot about, well, I'm not going to ask you to comment on temporary foreign workers and student. I'm talking about the increase in population, or the population flow through those, avenues like permanent resident applications, et cetera. What about the supply demand kind of dynamic in Canada? And again, sorry, let me just preface, you do real estate investing throughout the world, but especially in the States and Canada. But what about that supply dynamic? Well, I guess in both. I mean, I'm looking at immigration numbers in the States. They're both going to be lower than they'd been for quite some time.
Let's talk about supply first because it's much easier and much more clear. Um, Supply has fallen off a cliff in virtually every property type across North America. The combination of the big, interest rate increases over recent years, inflationary pressures, construction costs in our wonderful country, development charges, which are prohibitive, and then you add immigration crackdown, so the supply of labor has been challenged. You add tariffs, add in construction costs. It's very difficult to make the pro formas for new development work in any asset class. So that bodes pretty, and that's whether it's a good asset class, a favorite asset class, an under-favored asset class. New supply has really come down. That bodes pretty well for the sector generally over the next 2-3 years. Demand is more selective. I mean, we're cautious on apartments in North America. US is mostly a supply issue. In Canada, it's mostly a demand issue. Uh,
Mhm.
the immigration numbers, I mean, our sole core position apartments is Boardwalk REIT. Because there's 72% in Alberta and Saskatchewan where there's no rent controls. The challenge in Canada in apartments is most markets have rent controls, so your rents are capped in a gross rent market. What does that mean? If you, even in office, most leases are net rents where the tenant pays their proportionate share of operating expenses, property taxes. Not in apartments. You pay your monthly rent and that's what you pay. So when your costs are going up, and your revenues are capped, that's just not a good recipe. And then when you add the impingement on demand, it's a challenging space today in our view. So we like Boardwalk, but we're cautious generally for the reasons you're querying on supply and demand. Other sectors, I mean, grocery anchored shopping centers, supply, we like that space because demand is solid. Supply has really been muted. Industrial supply, there was a lot of new supply in North America. Supply has really come down. It looks better the next couple of years looking forward. Seniors housing supply has been muted the last decade. We like that space. So that gives you some sense of what's going on.
Well, again, I can't help but interesting their geographical, focus to areas. I'm talking now for REITs or any kind of apartment rental, that kind of stuff, rental market, to the two markets that don't have rent control. I mean, looking out in British Columbia, I think it's going to be a disaster because they've capped the rents, well below what the property tax, insurance increases, maintenance increases. It's just not viable, in my opinion, not an attractive investment right now at a time when all our governments pretend they want more supply. Well, you don't do the opposite to get that. It's just a fascinating time. Look at the Ontario numbers, for example, and I think they're planning. Just the recent numbers come out. They're planning for the worst year for housing starts, like since I didn't have gray hair. It's just a reminder how important it is to look at these various factors as you go through.
Yeah, I mean, I get that. I mean, Main Street, I didn't mention Boardwalk. Main Street is a corporation, not a REIT. So another inefficiency in our space that people
Yeah.
focus on. Main Street's focused in Alberta and Lower Mainland, and they retain their cash flow, and you can get that exposure in non-rent controlled markets through the stock market.
Let's come to some specifics to elaborate on what you're saying. I mean, one of the things I always enjoy is obviously you've been excellent pickers, stock pickers in the real estate sphere, or shorting it sometimes too. But give us an example of something we could put on our radar just to understand further how the approach of Vision Capital.
Well, there's 3 or 4 constructive themes we have, and maybe I'll give you a couple
Mm-hmm.
in each of those themes. So I mentioned briefly grocery anchored shopping centers. We like it in US and Canada. The anchors, a Loblaws, a Safeway, a Publix, and there's no fashion. The ancillary tenants are necessity based. You can't get your hair cut online. You can't get your dry cleaning done online. So it's a very defensive sector, very limited new supply, particularly in Canada. We like that space. We like First Capital REIT in Canada. This is a $4 billion market cap. It's got a 4.6% dividend yield, trading at about a 15% discount to NAV, excuse me, net asset value. We like InvenTrust on the New York Stock Exchange, similar themes, grocery anchored in the Sun Belt, smaller cap, 2.3 billion, trading at a 15% discount to NAV. So that's one sector your audience would do well to look at. Data centers, you mentioned, we like it.
Yeah.
A jewel of a name, off the radar screen. This is a really, really hot sector where you can buy digital core management on the Singapore Stock Exchange, get a 7% yield at a 25% discount to value. And yeah, it's listed in Singapore. Why? Because there's no tax on dividends in Singapore, but their assets, they got 11 of them. They're in Toronto, Frankfurt, Northern Virginia, Silicon Valley, Los Angeles, and Osaka. So, everybody's trying to figure out how you can get into data centers. Here's a name you can get it with a 7% yield at a 25% discount to value. We also like the big granddaddy in this space, Equinix, 100 times bigger than Digital Core, trading at a 30% discount to NAV, $76 billion market cap, really well positioned. I mean, every morning you pick up the Wall Street Journal, the Global Mail, there's some pension fund institution says, I got to be in data centers. I got to be in AI. We say, how? How are you going to do that? You have no global technology relationships. You have no global development capability. And so the large public incumbents like Equinox and Digital Core are doing really well to help these pension funds get exposure and generate some management fees on top of it. Industrial, we've shifted around since we last chatted. We like more small bay industrial. All the new supply was at big box, major regional stuff. We continue to like Dream Industrial REIT in Canada, and we like a couple of UK names. They've really been punished because the 10-year gilt, equivalent to 10-year bond over here, is like the highest level since 2008. These stocks have been crushed. You get great names: Tritax, Big Box, B Box, BBOX is the symbol. Segro, SGRO, they're both around 5% yields. They're both trading at 20% discounts. They're both exceptional quality properties, really well managed, off the radar screen, but large cap. And the last sector I'd mentioned, touched on it briefly, seniors housing. We like it in Canada, United States, but Canada is way cheaper. Sienna REIT, SIA, 5% yield, trading at a discount, and Chartwell, which is the biggest name in the sector, trading at a discount, nice yield, no tariff risk, no recession risk, seniors housing, very limited new supply. And where these names are trading at discounts, the US sector, where the fundamentals are good, but the stocks are trading 40, 50% premiums
Wow.
of value. So Canada discount, US at a premium, Canada looks pretty good in seniors housing.
Let me come back to some of the yields because they, I use the cliche, they're mouth-watering. But when I hear there's a 7% yield, for people who are looking for that, and you're also finding them at net asset value discount, a discount to that, something like Digital Core. How do you assess how safe that payout is?
Well, firstly, we do top down, bottom up. We do top down to figure out the property types and geographic regions, and that's based on supply and demand. And that's the key to this sector: supply and demand. I mean, for 10 years, we saw flat rent growth in up until 2022 in data centers because while there was solid demand, it was being met by new supply. Well, that changed dramatically about 3 years ago because anybody who knows anything about data centers understands the key gating factor is access to a lot of reliable, redundant power. Well, municipalities started to figure it out, putting a strain on the power grids, and you start to see moratoriums on new development because of restrictions on power. So now you have significant increases in rents where they used to be flat. And so supply and demand is in the right place. You don't need to rely on AI. AI is gravy. You're seeing the demand from the cloud today. AI is starting, but it's really in nascent stages. And so you assess supply and demand, you get a sense of where forward-looking rents are going to be. And these are really well managed. So we look at governance, we look at risk in terms of execution, and these large public comps are significant. Now, Digital Core, to your question specifically, it's externally managed by Digital Realty. So this is like a $50 billion market cap, one of the two big places. It was a spin out to hold some of the stabilized assets from Digital Realty. So management is in our view, the best in the industry.
But when I hear you speak here, Jeff, it just further emphasizes that that's why you get professional management. I think most people listening will be familiar with the sectors we're talking about, but the deep dive you have to be able to do to assess different areas, but also different companies within those areas is apparent. And again, I'll remind people, the track record has been excellent at Vision. And what I think people are interested in is the Vision Alternative Income Funds, which is RRSP eligible. For example, I think it was 219 when you started, but has well outperformed a strong stock market, but still outperformed. But as I say, I'm just encouraging the data center example you gave, the AI example you gave. People sort of have an understanding and an interest, but you need professional management for that. It's a full-time job picking which ones that people should commit their capital to. And I'm going to come back to a stat that you gave earlier that because I've been following it and you have mentioned these companies on Money Talks and made our listeners money. And that's the takeover aspect. When you find something that's really undervalued and then, you get a big boy coming in and paying, takeover premiums like 25, 30%, and you've had, close to 24 of those.
Yeah, firstly, it protects you on the downside. When you're buying stocks at a discount to net asset value, one of my former clients used to say, he was from Newfoundland, so pardon the twang. It's hard to fall out of bed when you're sleeping on the floor, by. So when you're buying stocks at a discount and things correct, it gives you some protection. But
Right.
the upside, and we don't like to buy things and, hope there's going to be a takeover.
Yes, fair enough. Yeah.
Bonus. But when you're buying quality real estate, and when the data from Preqin, I think $600 billion of dry powder sitting with the Blackstones, Brookfields, private equity funds, fully funded, sitting in cash, looking to buy properties, they figured it out, right? They figured out the cheapest way to buy real estate is often through undervalued shares of publicly traded enterprises. GIC, they've shown a commitment to Canada. In 2022, they bought Summit Industrial REIT at a 30% plus premium to get into the industrial space in Canada. And it hasn't closed yet, but they're going to buy Interrent at a 35% premium. That says they like Canada and they like these two asset classes and they like the valuations. And so you can do that in the stock market. By definition, you can't buy real estate cheaper in the property market than the property market.
Yeah, the other thing I don't want to finish without emphasizing this is where the picking aspect comes in. Because I know reading the data, you can get a bad REIT and a good REIT, but the difference is huge in terms of return. So it is a case of picking the right ones.
Yeah, we're governance hawks. So you got to watch out for misalignment of interest like any industry. But
Hmm.
hawks is where we spend a lot of time in terms of active engagement. Management teams, they don't always agree with us. They typically always respect our view. But also not being married. I mean, go back to data centers. This was our number one attribution to the fund in 2024, and we took a lot of profits. And then we had earlier this year, we had this DeepSeek AI head fake where people thought, AI, you don't need this. Well, that was ridiculous, and it gave us a great opportunity to re-enter the space at a big, it particularly hurt. I mean, Equinix.
Yeah.
They announced that because of all this opportunity, they were going to dramatically increase their developments because they were generating over 20% return on these developments. Now, as a long-term fundamental investor, that sounds like a pretty prudent thing to do. Well, the stock market can be short-term focused. And so folks were concerned, even though they were generating, still after they've made these expenditures, still generating 6 to 9% cash flow growth, that they were concerned that investment, the interest on the investment was going to hurt their near-term earnings, and the stock got crushed.
Hmm.
We plowed into Equinix when that happened. Good long-term decision by management. Stock market gets concerned that it's going to hurt their short-term cash flow. This was an opportunity earlier this year on top of the DeepSeek AI head fake. So you get these opportunities in the stock market. And if you're on top of it and you know your names, so you can react accordingly.
Just a quick question about the Vision Alternative Income Fund, which is eligible for RSPs and individuals buy it, et cetera, and also the Vision Capital Fund. But I'm just asking, what would be the hold period if you were recommending, because this gives people exposure to a lot of markets, as they can tell by listening, that they might otherwise not have an opportunity to do. And I'm just saying, would you say, well, you got to expect to hold it for 1 year or 3 years, whatever it is? But what would be the time frame that you'd be suggesting people realistically hold for?
Firstly, if the facts are you have monthly subscriptions, monthly redemptions, so you can come in and out as you please. In our view, most of our core funds, our strategy is longer term investing. We'll hold our core
Hmm.
holdings for years. We'll trade around them, but the themes we focus on are driven by supply and demand fundamentals that typically 18 to 24-month period to work out, whether it's the long side or the short side. So I would recommend that folks don't come in unless they're contemplating a year, 2 years hold. But listen, people they want to buy a house or buy a boat. You got liquidity, and it's one of the advantages, of course, what we have compared to a lot of private REITs where redemptions are illusory.
Yeah.
Uh, you, in theory, can redeem, but what we've seen is we've seen gating. Anytime you have a mismatch between the underlying liquidity of what you're investing in And the liquidity you promise your investors, those are actions waiting to happen. And a year ago, there was headlines in the Wall Street Journal about Blackstone's B REIT, Starwood's REIT, KKR in Canada, it's Romspen and Hazelview and Nine Point and Kingset, where they've all gated their investors from being able to exit. We don't have that issue in Vision because we deal in publicly traded securities. So people want to exit, they can do so on a monthly basis in the Vision Alternative Income Fund.
Yeah, obviously an incredibly important aspect there. I'm glad you brought it up. But as I say, if people can find more information by going to visioncap.ca, visioncap.ca. Jeff, as usual, brilliant job, and congratulations on the results you guys are getting.
Thank you. By the way, Michael, we also pay a distribution.
Mm-hmm.
It's in Vision Alternative Income, it's 4%. So you're getting some return. If you take that outlook of 18 to 24 months outlook, you're going to get some return on a monthly basis along the way.
Great stuff. Thanks again. I really appreciate you finding time, Jeff.
Nice to see you. Be well.